Thank you so much for joining us today. We'll be welcoming back our very own Dr. Donald Chambers for our informative presentation on equity volatility, past and future. My name is Jenny Dunberg, and I'm the Marketing Director here at Biltmore Capital, where we can help with your wealth management needs, from investment strategy and retirement planning to income and asset protection when it comes to your estate planning needs. We provide these monthly webinars in order to educate you on the timely and relevant topics pertaining to the financial industry, and hope they help bring light to areas that can help improve your individual financial situation. If you have any questions from today's presentation, please feel free to email me at marketing@biltmorecap.com, or you can drop a line in the Q&A section here, and I will be sure to have someone reach out to you after our presentation. Now on to introducing Dr. Donald Chambers, our Senior Investment Strategist. He has authored and published numerous articles and books on investments, corporate finance, and risk management. Dr. Chambers, thanks so much for joining us today, and we look forward to what you have to present. On that note, I will let you take it away.
Well, thank you, Jenny, and thank you for those of you that are tuned into this webinar. I'm going to talk today about equity volatility in general. By that, I mean the U.S. equity market primarily. And I'm going to talk about the 200-year past, what's been happening more recently, then focusing on how much loss is involved, the downside volatility, the way to prepare it for it, and what financial planning can do to help in preparing for that volatility. I'd like to start with, when we think about the last 2 centuries of the US stock market, we can think about the underlying changes that have been taking place. They're just massive. For instance, the economy went from 200 years ago being an agricultural subsistence sort of economy through a manufacturing, and now we're in this information technology phase. The monetary system went from no central bank to a central bank to now possibly cryptocurrency. Taxation has gone in 200 years from almost no federal taxation to some to just massive and broad taxation. Transportation, it took a horse months to take you across the country. Then maybe 100 years ago, a car could do it in days, and now we do it in a jet in hours. Information is going so quickly now. It used to be carried on newspaper by horse, and now it's internet, instant. And very importantly, the trading of assets, it's financial assets in the stock market has gone from real assets that you might not trade except every few years to stocks and bonds in the last 100 years, where you trade maybe every day. I remember being young, and the update you would get on stock prices would occur every day in the newspaper. And now, of course, we can see it in terms of seconds on the internet, the most recent trading prices, and the use of funds and derivative securities has expanded. So there's all of these enormous changes, but it's interesting. I'm sorry, and let me add one more thing here on this next slide as to what the changes included. This illustrates in the 200-year history of trading that back in 200 years ago, the trading was primarily of bank stocks. There really weren't many corporations, if you will, with manufacturing facilities, obviously, that long ago. So it was bank stocks. And then in the late 1800s, it switched to railroads. You could invest in railroads. And then in the 1900s, the big explosion here, and we switched from the yellow dominating it now to these 3, the blue, the pink, and the reddish, and the green, starting to expand and take over throughout the 1900s. And then we see at the end of the 1900s, these other areas were manufacturing and services, goods and services, this big change taking place and growing into the late 1990s is information technology, communications, and healthcare, these services. And it peaked in 1999. And this graph stops at around 2013. If it continued into 2021, you'd see those things coming up now to dominate on a long-term basis the types of underlying investments that the stock market invests in, that the stock market holds. So with all of these massive changes, let's look at what's happened over the last 200 years. Now, this is a graph that's in retrospect, filling in what the S&P 500 would have done if it had existed back then from a period of over 200 years here. It's done on a logarithmic scale. On the left side, the vertical, these are not dollar signs. This is the logarithm. And without getting into the mathematical complexity of it, it really makes it simple, because what it does is it makes a percentage growth at the left-hand side the same as the percentage growth at the right-hand side along a straight line. If we were doing this in terms of dollars, the graph would start low, would stay really, really low, and then would all of a sudden shoot up like the side of a volcano to being almost a vertical line by the end. Because if you did it in terms of dollars, like the Dow Jones is 30-some thousand points now, and back then it was less than 100 points. Back here, it was less than 100 points. So to instead of dealing with dollars, we do it on a percentage change basis, logarithms. And what that means is that this straight line of red is in growth after inflation of 7.1%. And what this graph is making is an amazing point. And that is that the growth rate on average through time of this US stock market has been rock solid at 7.1%, ignoring the variation, the short-term variations that are occurring. Now, these variations are massive. Like if we look in the period right here in around 1920 to 1929, this is the roaring 20s, just this enormous bull market. And then we hit this period that if on the graph, it might not look terrible. It is terrible. It's the Great Depression. And it falls down from 1929 to a low in 1932 or 33. And it takes up to maybe 20 years to get back to the point of profit, including inflation, after inflation. So these fluctuations, although they might look trivial, are really masking large periods of discontent here. I remember investing through the 70s and 80s, a 20-year period where the Dow Jones ranged between 600 and 1,000. It was really dismal. And we went through a dismal period in the early 2000 aughts, from 2000 to 2005 or 6. So there's been periods here of real bull markets and real bear markets and a Great Depression and a great financial crisis occurring right here. But through all of this, the average return that investors tended to earn across large periods of time has been fixed. That to me is just an amazing point of how consistently the US stock market has turned out value. Let's go to a graph that's a little more recent. It's a similar graph. It's on a logarithmic scale, but it actually shows the $1,000 increments, that each line here is a 10-fold increase. And it starts back in January of 1926 and goes through virtually today. And this is a graph that I think is so important that we have this embedded in every one of our investment committee meeting reports, which we hold quarterly at Biltmore Capital, because we want to come back to the reason that we invest the way that we do. And the reason that we invest is focused on asset classes. And what this is showing is the relative performance of asset classes over the last 100 years. If we go to the bottom two lines, the bottommost line is the inflation line. This is the amount of money that you need to have the same as $1 of purchasing power back in 1925, and it's about $11. That's a lot of inflation. If you look at what Treasury bills did, Treasury bills have barely outperformed inflation. And because you have to pay taxes on the total return, not inflation-adjusted return, on an after-tax basis, Treasury bills, in other words, any short-term, safe money market sort of investment you made, whether it's in a short-term CD or at a bank, after taxes, it probably has not kept up with inflation for the last 100 years. So we might need to do this to store some wealth occasionally, but it's a losing proposition. You're going to lose money, especially in today's environment. What about fixed income securities that have longevity to them, 5, 10, up to 30-year bonds? Well, they seem to have performed pretty well. They seem to have outperformed inflation, maybe enough to more than pay taxes. But notice that they didn't do it over the first 55 years. This was a period of rising interest rates, especially in the 70s. So at the end of 55 years, on an inflation basis, bonds wouldn't have earned you anything. Now that interest rates have come down so much, absent the recent year, they outperformed Treasury bills and maybe earned a profit. So the way we think about this in the middle, if you look at it, is what gives us premiums when we invest. And does the time value of money, in other words, just putting your money in the bank, give you a premium? No, it hasn't. Do we get a premium by investing in interest rate sensitive assets like bonds? Yes, a small one. I put it in lowercase letters here. Do we get a premium by investing with credit risk? Well, if you look at the separation here between corporate bonds and government bonds, it's trivial. So there really isn't much of a credit risk premium, if any. But is there an equity risk premium? And this is the point. This is where people can make their money, have made their money in the past 200 years. And where we might think it's reasonable to believe that in the long term, that's where people are going to make their money in the future. We need to be a little bit careful because we're looking at a success story, the United States. There's a whole bunch of countries that got devastated by wars and they haven't done so well. But the United States has been this haven of fantastic returns for over 200 years, and stocks is where people have been making their money. So let's turn to volatility now and look at not the growth in the stock market, but how volatile it's been through time. And this graph on the right shows as it goes up, that's high volatility, and when it's down, that's low volatility. Now, when we use the word volatility, we mean it kind of casually to say the amount of the magnitude of the changes up and down that are taking place in the market. But in finance, when we use the word volatility, we're often mean a very specific statistical measure known as the standard deviation. And that's actually what this is in this diagram. And what this diagram shows, you can see the volatility that occurred in the Great Depression. And in 1987, there was a 4-day crash, a Wednesday through Monday crash in mid-October of 1987. We get this volatility. And when the dot-com crisis was occurring, we get tremendous volatility with the great financial crisis. And then we got this COVID crash. So that's when volatility is high, is when these huge drops take place. And those are the 5 major events over the past 80 or 90 years. Now I have 2 more. This is the same graph on the right-hand side that we were just looking at. Here's another measure. There's different ways to measure this volatility, and this kind of graphs it differently. And if we look at this period of almost 100 years, over 100 years here, we might come away with this idea that volatility is declining. If you were to ask me 20 or 30 years ago, was volatility declining? I would have said yes, because we were focused on this lower part here. You kind of throw this out, and it looked like there's a slight downward slope here. In fact, volatility was judged to be in the area averaging this all of around 22%. And then it was down to 20%. And we reached a point here where we were thinking volatility was really closer to 16%. You can view that roughly as the amount by which the stock market would abnormally perform in a year, 20% higher or 20% lower than you thought it was going to. So if we look at this, we see kind of declining volatility. But if we look at this graph, it's very similar to the other one. But all of a sudden, you start to focus on this later part, and it looks like it's going up. And more to the point, there's 4 major events here that have occurred in the last 40 years, 35 or 40 years. There's only 1 major event of that magnitude that occurred in the previous 50 years to that. So it looks like we're having more events. And we might argue that these events are occurring in more of an emotional way and that they're very fast. An illustration of that is the most recent one, which was the COVID drawdown. A drawdown is simply, it's not trying to minimize it. It's a horrible thing to go through. A drawdown is simply when the stock market goes from a previous high to a new low, to a low, to the lowest subsequent point. If we look at it in February of 2020, we lost 34% here in a matter of 1 month because of the COVID crisis. And then it took 4 or 5 months for it to get back up. Now, that's why I say here the elevator down and the escalator up. It's not just this example. It's almost always the stock market drops very quickly and it recovers slowly. Elevator down and escalator up. That happened with the COVID. As you look at this, you might say, well, this was clearly a buy point. Well, that's only a buy point in retrospect. If you look at it here, you might have thought, oh, there's a recovery, or this is a recovery, or this is a recovery. You never know when the recovery is going to occur. And you never know when a down movement like this, or this, or this, or this, or this is actually going to go back and you'll get a double bottom, or it'll go to even a bigger low. So trying to guess where the low is going to be and where the high is going to be is not what I think wealth management is about. We have a short-sighted brain, sometimes it's referred to as a lizard brain, that reacts very emotionally and very quickly. And it's a very valuable thing we have when all of a sudden we see an immediate danger coming at us. And then we have a long-sighted, more rational, logical brain. And the idea of wealth management is to focus on this long-sighted brain. We don't want to jump on the bandwagon in bull markets, and we don't want to panic when there's a drop. And a great way to do that, it's not the only way, but a great way to do that is to have a financial plan. And we'll come back to that later. This is a kind of a quick side trip. There are now futures contracts being traded, speculative securities being traded on the futures exchange that actually show us the market estimate of future volatility. You heard me talk about the idea that volatility was at one point maybe as low as 16%, and it's been as high as 22% as an average. Well, it jumps all over the place. In a crisis, these numbers will jump up to 80 because it's a measure of short-term future volatility expectations. And I just wanted to show this because it shows that the market is anticipating above average volatility for the next 6 to 8 months or longer. And I think that's reasonable. We've got a lot of headwinds facing the US stock market right now. We face unprecedented challenges in terms of maybe the virus will mutate again, massive federal deficits and debt going on, proposals for economic equality being federally legislated, massive expansion of social programs and potential social upheaval. These are some real difficult waters to navigate in the future, and it might cause one to think that there could be future volatility. We're also in this condition where US financial markets offer negative real returns in bonds. If you invest in bonds right now, after inflation, you should expect to lose money. Inflation recently was cited as being 6.2%, and treasury yields are down around 1 or 2%. So bonds seem to be a horrible place. Cash seems to be a horrible place. And equity has a lot of volatility. So there's no silver bullet today to protect and grow wealth. So how should we think about allocating our assets between these? Well, let's look at the idea of these drawdowns. A drawdown is sometimes a very short period where it goes from a previous high to down a little bit and then goes back up to a new high. That's what a drawdown is. And most of them are very short term. There's only a few that are long term and devastating. This is the Great Depression, and these are major periods of bad performance, but most of them are short term performance. This table that I'm showing, it is what happens when your stock market has reached an all-time high. And the takeaway message that I'm trying to get across here is that there might be a tendency to think that when the market has reached an all-time high, that's a time to get out of the market until it cools off. Actually, the statistics indicate just the opposite. Hitting an all-time high is a bad time to get out of the market, in the sense that the market is still pretty confident, investors are pretty happy, and that the real drawdowns, the long-term painful drawdowns, tend to happen when investors get discouraged. And investors are not discouraged right now. They're rather ecstatic about the performance they've received. So there's only one drawdown that's been lasted 7 or more years or exceeded 60%. And that was the Great Depression. So this might give us an idea that a huge drawdown like that, to repeat it, is very unlikely. It could happen though, obviously. There could be huge military conflicts. So this is going back to the bond yields right now. It's so discouraging that when inflation is running at 6% and bonds are only earning, this is the treasury yields recently, from 1, not even up to 2%. It seems like a guaranteed formula to lose money. Now, investing in the S&P 500, and granted, that seems to be very highly priced now, but it pays a dividend yield of around 1.2%. So one justification for investing in equities now can be that you'll earn almost as much in dividends as you will earn in interest over the next 10 years. But these dividends can grow, these coupons can't grow. And certainly the stock market has indicated that for 200 years in the long run or the medium run, it's tended to earn 7.1% after inflation. So it seems like bonds are really only an investment we should do for a safety net. And that, as painful as it may be, we need to buy and hold equities with a substantial amount of our money if it's a long-term investment and if we have the risk tolerance. Which really leads me into this: how do we make the decision between how much we put into equities and how much we put into debt? Well, one thing is a simple rule. This was an old-fashioned rule. Put your age in bonds. If you're 65 years old, put 65% of your money in bonds. That seemed to be a little bit too conservative in more recent years, so some people have upped it to 110. If you're 65 years old, you should put only 55% of your money in bonds and 45% in stocks. The rest of this would be going into stocks. Some people would do that. Well, we think at Biltmore that it matters a lot more, not just your age, but other issues such as your risk tolerance and your financial situation. Here's kind of a strange idea I just wanted to throw out there. One way to do this is to look at your life and what you need from your investments to lead a reasonably comfortable life. So if, like, I'm in the position where I've made sure I've paid off all my debts, cars, mortgages, everything. I'm not in Social Security, but I could be drawing that soon if I wished. I have a rather poor lifestyle. I don't tend to spend a lot of money. So I actually could afford to lose all of my retirement money and still, because of Social Security, be able to, and my house being paid off and things like that, be able to lead a reasonably comfortable life. It wouldn't be, I don't have all my money in equities, but this is a way that you might want to think about it, is maybe you should put into equities everything you could completely lose and still be comfortable over the next 10, 20, 30, 40 years. And then you'd be quite relaxed, but you'd still have a lot of upside potential, because odds are the equities in the long run are going to do much, much better than the bonds. More formally, at Biltmore, we recommend to our clients a percentage in equities based upon an analysis of your tolerance of risk, your financial circumstances, and your investment experience. So we do that. We look at that with a questionnaire, and we come up with where you should be in terms of our model portfolios. Should you be very aggressive, moderately aggressive, all the way down to very conservative? But the best way to do it, and what we try to do with our clients, is to do it based upon your financial plan. This is not meant to be a moneymaker for us. This is meant to really help our clients understand what's going on and come up with the right amount of equities. And it's not only to come up with the right amount that a client should put into equities, it's to have them understand why it's the right amount. If you could have a financial plan where you knew that that the bonds that you have will be sufficient to carry you through a number of years, and why the financial plan is set up to balance the risk of damaging yourself by being too much in stocks versus the benefits of being in stocks in terms of long-term higher growth. That's what the financial plan is it balances the risk and the return in a way peculiar to your financial situations, and maybe when you might be planning on retiring, and whether you have debts and things like that. So lastly, I want to finish off with 4 financially healthy strategies, maybe some go-away points here of things you could think about doing. The first one I hit on is to have a financial plan that you understand and that you believe in the plan, and both you and your spouse. I can't emphasize that enough. I urge married couples to talk about money with each other and agree on how much money should be put in different places. That shouldn't be a point that comes between the two of you, especially when things get bad. I urge you to work this out with your spouse. I think that a lot of times my spouse can help balance my enthusiasm and greed sometimes with her common sense. Focus on that financial plan when markets get volatile. Don't think about it. Is this an opportunity to get in? Is it an opportunity to get out? No, it's a time to stick with your financial plan. Your financial plan is designed to handle volatile markets, and sticking to that financial plan and thinking about it will help you get away from trying to time the markets. Now, we do at Biltmore some asset allocation based upon market conditions, where we can tilt relatively small reallocations based upon market conditions. but it's not something that we do in large amount, and we don't do it on an emotional basis. We do it on an evidence-based. So we don't want to try to time the markets, certainly emotionally, and we only want to do minor tilts when circumstances and evidence indicates that they might be able to enhance return a little bit. As a last point, in these very difficult times, and when I say difficult, it's a difficult time to be an investor because the stock market is so high, the bond yields are so low, the economic, in my opinion, the economy is very uncertain at this point. It's remarkable that it's recovered the way it has, but it's really amazing that the stock market is so high, so much higher than it was before COVID. So what could you do with some assets? I like the idea of investing in real assets, but real estate has gotten incredibly pricey as well. Maybe you could put money into some home repairs or improvements, even putting on solar, paying for it rather than financing it, paying for solar electricity with your house. I believe in buying ahead, not hoarding, but having a large supply of food and pantry items, a good time maybe to buy tools, and maybe even a time to invest in personal infrastructure. What do I mean by that? Maybe to get an education or a certification if you're younger, medical work or dental work. This might be a good time to get to invest in those sorts of assets right now, because frankly, with the stock market being so high and the bond yield so low, it's hard to find a really attractive set of financial securities to be into. So I thought those might be some helpful strategies. I love talking about investments and volatility and return and all these things and asset allocation. So I urge any of you to contact me. Just call Biltmore. They'll put you in touch with me of how you can get in touch with me. I love to talk about this stuff. And I certainly appreciate you staying this long and listening to the webinar. And if you have any questions, Jenny has told you, and we'll tell you again what you can do. As I say, always feel free to contact me through calling Biltmore. Thank you. Jenny, back to you.
Thank you so much for joining us today. And thanks again, Dr. Chambers. It was very informative. And just as a reminder, if you have any additional questions for Don, or if you would like to set up a time to review your plan with us, with one of our senior advisors, please email me at marketing@biltmorecap.com, and we'll be sure to get back to you. Hope you have a wonderful rest of the day.